Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, Mena and I today would like to talk about giving to charity and passing money on. I guess there's going to be two ways that if you accumulate wealth and more wealth than you need, part of it is, and predominantly the first sort of port of call or priority for people is to look after their family, particularly, surviving children and so forth, even if they're adults and even if they're already well established. But also clients talk about giving money to charity or creating their own charity for an area of interest that they really connect with. And there's ways that you can structure this sort of gift giving that is both going to deliver or maximize the tax benefits to you, maximize the control around who is going to benefit from that gift giving, and then also the control around, and in particular, the time that it takes to give those monies away, because you don't necessarily want to be forced to make a very large donation in one particular tax year. You might want to control it and drip feed it over a number of years. So we're going to talk about private auxiliary funds, which, Mena will talk about, explain what they are and guide you through sort of the realities, costs and controls and considerations that you need to take into account. And even if it's not something that's on the horizon today, you just never know what's around the corner. And, if you, unexpectedly sell your business, like you get an offer you can't refuse down the track, or you're going to sell a large asset that's going to have a large capital gain, this is something to keep in the back of your mind, particularly if you're of a mind to donate money to charity or help charitable causes.
So what a private ancillary fund is really just a structured vehicle that you have complete control over. So you might, for example, in an instance where Stuart said you've got a large capital gain one year from a sale of a property or a business or the like, you don't necessarily want to give it all to charity in 1 year and you don't know how those funds are exactly used. So what you could do is actually set up what is called a private ancillary fund, where is basically a charity of your own doing. So a charity that is registered as a not-for-profit and with the ACNC, and you donate capital from your business or from you personally into this private foundation. The foundation can then hold the capital for a while, for a period of time, and invest that capital, or of course as guided by the constitution or the governance of that fund, and it then distributes those funds to registered charities over time. So you get the benefit of it. You can invest those funds if you've got the know-how and you've got the complete control over how those funds are used and the time frame that they're used. So it's really good from a family perspective, especially if you want to get your children involved and get the next generation involved. It gives them the idea of how charities work and how to be sort of get in the mindset of gift giving. Now, private ancillary funds are quite a powerful tool. They don't come cheap, unfortunately. Their setup costs in terms of setting up a legal structure. You need sort of accountants and solicitors involved in sort of setting out your constitution. You need to be registered with the ACNC. There's audits involved. You need to get ATO endorsement around being sort of a deductible gift recipient. So it's really, really used when the initial corpus or the initial funds are sort of north of $500,000 is the general guideline. Now, as I said, there's ongoing compliance in terms of annual financial statements. There's got to be a minimum annual distribution each year, usually around 5%. So that's the minimum amount you got to give each year to a charitable cause. And there's got to be governance around your investment strategy. So you can't just go and invest it in anything and everything. There's got to be some sort of governance that you're accountable for, and it's got to be all within the guidelines of your constitution. So where this really gets interesting is when philanthropy is actually integrated into the broader family strategy, the wealth side of things. So I'll hand it back to Stuart to speak about that.
I think the first thing to really highlight or talk about is that it's got to be part of a longer term plan and longer term goals as well. So, and quite often we don't really think about this, and certainly maybe not at the beginning of our wealth building journey, but it might be that, people will want to give half of their wealth away and then half of it to leave it to their family members, for instance. At least they start with something like that in mind. And if we then kind of understand that, we can then sort of understand understand, okay, well, how much do we think is surplus? Because, you can obviously give or make those gifts and bequeath those monies when you pass. But, one of the things I think that most people would like is to enjoy seeing the benefit of those gifts while they're still alive. So that's the first thing we want to think about is like, to what extent are we going to be involved in this gift giving? And when can we start it? When is the soonest that is safe to start giving this money away? Remembering that you don't want to put your own retirement at risk, and also, want to make sure that you're providing for any loved ones in the way that you expected to do so. It could also be, in terms of part of a plan, if we know that we're going to divest of assets down the track, we can then consider that within the plan. So we can consider how we're going to minimise capital gains tax in that instance, and adding in a private ancillary fund could be a good way to do that, because of course, if you're making a contribution into that fund, you'll get the tax deduction in that year, just like donating to any charity, and that will offset or minimise the CGT liability. So that's the first step, is to work out how does it integrate into the plan? How can we work out how much can we give away without compromising any other sort of priorities that we might have? The next thing then to think about is how you're going to manage that money, because you can consider if you do start a private ancillary fund, you can consider that still as part of your overall wealth and manage it in a way that is still part of your overall wealth. All you're doing by having that fund is really just quarantining that money. As Mena says, you've still got to meet minimum gift requirements, but that's not going to be difficult to do for most people, but you can still manage it. So what I'm sort of saying there is, even if you sell down an asset like a business or a property, that's going to be one big lumpy transaction and give rise to a lot of capital gains tax, you can still say, well, we're going to put, $1 million of that gain into this charitable fund, and we're going to manage it as if it was still our own money, that we haven't given it away. So that means that you'd adopt an investment strategy that's kind of congruent with how you would invest money that sits outside of that structure. And that's the benefit of having these sorts of funds, is you've got complete transparency and control with how it's invested. So from our perspective, we would approach it just the same way as we would approach, managing a super fund or a family trust or a personal portfolio, in that our goal is to maximize returns whilst taking the lowest possible risk. And the benefit of that is that your initial contribution might be, like Mena said, maybe the minimum $500,000 could be $1 million. But if you manage that charitable foundation for a number of years, actually the money, and all you're doing is giving away 5%, the amount of money in those foundations can actually increase rather than, run down and reduce. So that gives you then the flexibility to make those donations while you're still around and enjoy that benefit. But also for your family members that you're going to leave behind, they're also going to experience that as well. And they'll experience, the benefit of your hard work or your family's hard work in being able to be in a position to do that. Also, because these foundations exist separate to the will, you can hand over control or share control and decision-making responsibilities, with the next generation. So again, it's a good way to kind of introduce them to the joys of gift giving and the benefits of gift giving without necessarily waiting, for that all to happen after you pass away. Because it's a lot on the executor's shoulders to say, like, if my will says give 50% of the estate to charity, you've got to go and pick some charities, and you're probably, depending on the size of your estate, making some significant decisions and making some significant donations in any one particular year. And I'm not sure there's a charity out there that I'd be comfortable giving, half of my wealth to, for instance. I mean, you want to try and spread the risk of it being used unwisely. And I think the best way to do that is by, making regular donations over many years rather than one big lump sum donation. So you can help that transition and maybe in a way sort of create intergenerational gift giving arrangements that also the future generations can benefit from. And once that entity is established, of course, you can then include it in your will. So if there's residual wealth, that goes beyond what you're wanting to leave to family members, that can go in and top up that charitable fund. So with the focus now, there's a stronger focus on capital gains tax discount, Senate committee review. Of course, there's going to be some sort of tax reform coming our way. Charitable causes could be the unintended beneficiaries of these sorts of changes, because we need to start then thinking about, tax liabilities and so forth. So I think there's really two ways where this approach is going to apply, where you unexpectedly, or at least maybe it's not unexpected, but you hadn't foreseen coming up into a situation where you crystallize a very large capital gain in one particular financial year. And this might be just one of the tools that you can think about implementing to manage that tax liability in that particular year. But we think a better approach is really to take a long-term kind of family office view to it. So what is your strategy in the situation where people expect to accumulate more money than they'll ever need and probably more money than their beneficiaries will ever need? Can we then include in the plan a tax effective way to start a charitable organisation? Okay, of course, it's going to be different for different people. So, like everything, this is just information, not advice. It's important to get that advice. But until next week, bye for now.